So I noticed that this team that was commenting on these proposals or put together to create these proposals just include economists and attorneys. I'm an accountant, so I can't figure out if the omission was intentional, but of course I'm going to come in and talk about all the picky details from the perspective, a little bit more of a practical perspective, but also from the perspective of an academic accountant. So I have two sort of broad areas that I was going to discuss, and the first is kind of on the academic work that as an accountant we talk about the information flow and how firms operate in aggregate to essentially, aid in the efficient allocation of capital to markets work correctly. And so one of the areas that I've thought a lot about as an accountant is, does tax planning essentially create another cost to the firm, and that's by adding complexity. And I don't think there's anybody in this room that would disagree that tax planning adds complexity, even just on an organizational structure basis. And so one of the issues, as I thought while reading this proposal, was, well, does this alleviate complexity, right? Does this take away the need for tiers of organization structures, entities, and flows that go through multiple jurisdictions? Well, potentially, and that would be a benefit essentially to the market because it would help make the financial statements more transparent or something along that line. But then my thought was, well, what happens if all parties don't play? And that's kind of the concern I've always had is the U.S. and every other developed country in the world going to adopt such a proposal? And if they do, then it's fairly straightforward to say this would be a simplification over the current regime that we have, even with regard to the tax rate issues that were sort of proposed. But what I started to think about, well, if there's at least one party that sort of steps away, what you have is this yet added layer of complexity, because essentially you have to do things in the old manner and then you have to do things in the new manner. And so there's this transition and there's time period at a minimum that you would have to deal with. What I thought was unique about this proposal is it essentially ignores any sort of intercompany activity. It was sort of stepping away as intercompany activity is deemed to be sort of artificial, right? And that creates distortions, I completely agree. But it's important to remember that intercompany activity or intercompany transfer pricing and the need for it does not go away with this proposal. And the primary reason is because inside the firm and how the firm operates is based on management and value flows within the organization. I mean, that is the whole area of managerial, academic managerial accounting, is sort of saying, listen, we want to incentivize the firm to make more money or be more efficient in how it makes money. And how we do that is by incentivizing management in a way that they're compensated for things that they can control. And so when you say, if you're manufacturing a piece of a component in one division that sells to another, well, you want to compensate those individuals in the initial segment for making that component better, faster, cheaper, even though that goes into something that ultimately isn't sold to an external third party for maybe 3 or 4 steps down the line. All right, and so that's kind of, to me, thinking about more of the economics of what's going inside the firm falls back to this problem with arm's length and managing things that aren't necessarily going to an independent third source. What other things are management, ultimately compensated for? Well, it's a variety of issues, not just cost cutting, but making sure that, the talent's happy and the talent sticks around. And so when it comes down to, well, listen, what I want to think about is the value that he or she creates in his or her sphere and make sure that rewards are placed there. So if I think about this proposal, and there's a lot of complexity to it, but just on a very basic level, if I want to reward a manager for essentially cost cutting, I could foresee in this type of situation, if it just happens to be that this manager is located in a tax jurisdiction that's considered low, and I'm not saying haven, but low is relative to other jurisdictions, that would be a bad outcome. Because by cutting costs in this low tax jurisdiction, essentially there'll be less sort of ordinary, or cost plus routine income added, which then creates bigger residual profits that could ultimately go overseas to a higher tax jurisdiction. So it seems to me that's kind of a big problem that needs to be thought about or dealt with. Otherwise, your whole incentive structure is just going to make sure that the sales force is selling into the right jurisdictions, right? I can see some really interesting behavior, and that was kind of, I think, touched on a little bit about the business-to-business versus business-to-consumer issues is something that also needs to be sort of addressed. I also thought about the customs duties functions and things along that line. I mean, all you still need is these values that are going to be appropriate there, and it's just not clear to me ultimately how that works in the absence of any sort of transfer pricing within the company. So then the last area I wanted to talk about is a little bit from my practice perspective. And so as you've all noticed, I'm from the US, and we had the very much, I call it a parallel experience with the state and local tax issue, all right? So this isn't a pure apportionment system, but it's essentially, for me, a two-tier type of apportionment system with a sort of routine profit and then ultimately an allocation based on the residual profit that everybody essentially agrees to be as a function of sales, right? And so what was interesting is I actually went back to, I think it was in the 1950s, is when this multi-state tax commission came into being. And they call it, I called it UDIPTA, but it's the Uniform Division of Income Tax Purposes Act. And the compact was put out to do the following four things. Facilitate the proper determination of the state and local tax liabilities across multiple taxpayers, which is multiple states, promote uniformity and compatibility, right? So they wanted to prevent states from being able to double tax income, or essentially other companies be able to avoid all tax at the state and local level. Facilitating tax planner convenience and compliance, basically trying to coordinate any dispute resolution, and avoiding duplicative taxation. And what they then put in is, because we have this 14th Amendment in the United States, is that every state had the right to participate or not. And when they originally put out the proposal, they said, here's what we're going to assume for apportionment, or how each state should apportion the income. Is based on sales, property, and payroll. Well, what's happened over the past 50, 60 years now is everybody's moved away from this three-factor formula to essentially some sort of formula that maybe weights sales more heavily, depending on what the tax base is in your jurisdiction. If you have a lot of people in plant, then it behooves the company. If you're in a state that says they double weight sales, because what it does is it says, listen, we want you to bring your capital here, and then we won't tax your sales, right? Because you're probably selling out of the state. Well, as soon as you have this sort of variation in these apportionment, what you do is you sort of undermine the whole equity of the system. And so that's where we've kind of wound up in the US system, is that you have, once again, I'll say a rat's nest of rules that ultimately leads to these holes that you can sort of tax plan and benefit from. And so to me, I view this issue as one big coordination problem. And it's never been clear to me as how you get sovereign nations to sort of agree to coordinate on this very high level and then let them play on the tax rate level. And so that's kind of the missing piece. But what I wanted to sort of close on is one of my favorite quotes is somebody from the Oracle of Omaha. And as I view this, Warren Buffett, it says, in the long run, management stressing accounting appearance over economic substance usually achieves little of either. And so that's kind of where I think that we need to step back here and say, if we can get the coordination problem done, this works rather nicely. But if essentially we're just focusing on the accounting rather than ultimately where the value should be placed, it's hard for me to, see where this is going to take us.
Thank you.